Question 1. Which of the following is a key advantage of a group captive insurance arrangement compared to single parent captive insurance? A. More control over underwriting and pricing. B. Easier access to reinsurance markets. C. Less regulatory oversight. D. Better ability to aggregate risks across multiple members. Answer D. Better ability to aggregate risks across multiple members. Explanation. Group captives allow multiple entities, often from similar industries or sectors, to pool their resources and share risks, making it easier to aggregate risks across members. This is one of the main advantages of a group captive over a single parent captive, where risk is managed solely by one company. Group captives are often better positioned to achieve economies of scale and diversify risk. In contrast, a single parent captive tends to focus on the specific needs of a single entity, which may limit its ability to spread risks effectively. Regulatory oversight and access to reinsurance markets are generally similar across both structures, and underwriting control is typically higher in single parent captives. Question 2. Scenario-based. Mr. Roberts, the CFO of a manufacturing company, is considering setting up a single parent captive insurance company to cover his firm's risks. However, he is concerned about the capital requirements and ongoing regulatory compliance. Which of the following factors should Mr. Roberts prioritize when determining whether to proceed with forming the captive? A. Ensuring the company has sufficient capital to meet initial and ongoing solvency requirements. B. Identifying a reinsurance partner to assume some of the risk from the captive. C. Securing approval from shareholders for the captive structure. D. Avoiding any association with industry trade groups or captive networks. Answer A. Ensuring the company has sufficient capital to meet initial and ongoing solvency requirements. Explanation. One of the primary considerations in forming a single parent captive is ensuring that the company can meet both initial and ongoing solvency capital requirements, which are a key regulatory concern. Capital requirements are often determined by the regulatory body, Alaska Division of Insurance, and are designed to ensure the captive has enough financial resources to cover its claims. This requirement must be met from the outset and maintained through the life of the captive. Identifying reinsurance partners, securing shareholder approval, and avoiding industry trade groups as secondary considerations. Though still important, reinsurance helps manage risk but is not as critical in the formation process as the capital requirement. Similarly, while shareholder approval is necessary, it is not as directly tied to regulatory compliance as meeting capital and solvency standards. Question 3. Which of the following best describes the role of an actuary in the financial management of a captive insurance company? A. To handle the legal formation and registration of the captive insurance company. B. To provide advice on risk management strategies and business continuity planning. C. To determine the appropriate amount of reserves for future claims and calculate premium rates. D. To oversee the regulatory filings and ensure compliance with tax laws. Answer C. To determine the appropriate amount of reserves for future claims and calculate premium rates. Explanation. An actuary plays a crucial role in the financial management of a captive insurance company, primarily through the calculation of reserves, funds set aside for future claims, and determining premium rates. This ensures that the captive is financially prepared to meet future obligations and can accurately price its products. Actuaries use statistical models, historical data, and various assumptions to determine the necessary reserves and pricing, while actuaries may indirectly assist with other functions like risk management, option B, or regulatory filings, option D. Their primary role revolves around financial assessments and pricing. Option A, regarding the legal formation of the captive, is more relevant to legal experts or captive managers. Question 4. Which of the following is a primary advantage of a protected cell captive insurance arrangement over a group captive? A. Greater risk pooling among members. B. More flexible in terms of ownership and control over individual cells. C. Reduced capital requirements for each participant. D. Easier access to external capital markets. Answer B. More flexible in terms of ownership and control over individual cells. Explanation. A protected cell captive offers flexibility in terms of ownership and control over individual cells, where each cell operates as a separate entity under the same umbrella, allowing for more customization for each participant. This structure enables individual participants to manage their risks independently while benefiting from the shared infrastructure. While group captives offer pooling of risks, the protected cell structure allows participants to have more control over their own operations and liabilities within their cell, which is advantageous for companies with unique risk profiles. Other options like reduced capital requirements, C, and access to external capital markets, D, are not specific benefits of protected cell captives. Question 5. Which of the following regulatory filings is a captive insurance company in Alaska required to submit annually to ensure compliance with state regulations? A. Audited financial statements and an annual report. B. Business continuity plan and risk management policies. C. Investment strategy report and performance analysis. D. Certificate of good standing from the IRS. Answer: A. Audited financial statements and an annual report. Explanation: Alaska captive insurance companies are required to submit annual filings, including audited financial statements and an annual report. These filings provide the Alaska Division of Insurance with the necessary information to assess the company's financial health, solvency, and regulatory compliance. The reports are critical for maintaining oversight of the captive's operations and ensuring it adheres to the state solvency requirements. Other options, such as business continuity plans, B, or IRS certificates, D, are not standard annual filings, though they may be requested under certain circumstances. Question 6. Which of the following statements best describes a risk management strategy typically employed by a captive insurance company? A. Avoiding any exposure to risks that could be covered by traditional insurance. B. Retaining more risk internally through higher deductibles and lower premiums. C. Transferring all of the risk to third-party reinsurers to minimize exposure. D. Diversifying investments to hedge against underwriting losses. Answer: B. Retaining more risk internally through higher deductibles and lower premiums. Explanation: a common risk management strategy for captive insurance companies is to retain more risk internally. This is achieved by setting higher deductibles and charging lower premiums. The purpose is to reduce the cost of insurance by assuming more of the risk themselves. This allows captives to have more control over their risk management and claims handling while potentially increasing their profitability. While some risk may be transferred to third-party reinsurers, retaining risk through higher deductibles is a core strategy for most captives. Options A, C, and D describe different, less common strategies, but do not reflect the typical approach for a captive's risk management. Question 7. Which of the following is a key tax consideration for captive insurance companies under IRS guidelines? A. Premiums paid to a captive insurance company are always non-deductible. B. Captive insurance companies are exempt from state and federal income taxes. C. Captive insurance premiums must be charged at arm's length to ensure deductibility. D. Captive insurance companies are not required to file tax returns in the U.S. Answer: C. Captive insurance premiums must be charged at arm's length to ensure deductibility. Explanation: under IRS guidelines, for a captive insurance company to qualify for tax deductions on premiums, the premiums must be charged at arm's length. This means that the pricing of premiums must be similar to what would be charged by an unrelated third-party insurer under similar conditions. This ensures that the captive is not being used as a tax shelter, but rather as a legitimate risk management tool. The other options are incorrect. Premiums may be deductible under appropriate conditions. Captive insurance companies are subject to taxes, and captives must file tax returns. Question 8. Which of the following is a disadvantage of using a single-parent captive insurance company for a business's risk management? A. It can result in higher premiums due to limited risk diversification. B. The business loses control over the pricing and underwriting decisions. C. The company must rely on group pooling to reduce its costs. D. The company is subject to higher regulatory oversight and complexity compared to traditional insurers. Answer: A. It can result in higher premiums due to limited risk diversification. Explanation: a single-parent captive insurance company faces the disadvantage of limited risk diversification since it only covers the risks of the parent company. This lack of diversification can lead to higher premiums because the captive has to manage and retain more risk on its own. In contrast, group captives or protected cell captives allow for better risk diversification, which can lead to lower premiums. The other options are incorrect because in a single-parent captive, the business typically retains control over pricing and underwriting. B. And the regulatory oversight is not necessarily more complex than other insurance structures. D. Question 9. When forming a captive insurance company in Alaska, which of the following is a critical first step? A. Obtaining a business continuity plan from the company's board of directors. B. Completing a feasibility study to assess the financial and operational viability. C. Establishing a reinsurance contract before applying for regulatory approval. D. Registering the company with the National Association of Insurance Commissioners (NAIC). Answer B. Completing a feasibility study to assess the financial and operational viability. Explanation: the first critical step in forming a captive insurance company in Alaska is completing a feasibility study. This study evaluates the financial, operational, and risk management viability of the captive. It helps determine whether the captive structure will meet the company's insurance needs and if it can financially support the required capital. While obtaining business continuity plans or reinsurance contracts is important, they come later in the formation process. Registering with the NAIC is generally not the first step. The captive must first meet state-specific requirements before proceeding to national-level registrations. Question 10. Which of the following accurately describes the role of a captive manager in the operational structure of a captive insurance company? A. The captive manager is responsible for setting premiums and underwriting decisions. B. The captive manager oversees the day-to-day operations and ensures regulatory compliance. C. The captive manager reports directly to the board of directors and makes all financial decisions. D. The captive manager only handles claims management and loss reserving. Answer B. The captive manager oversees the day-to-day operations and ensures regulatory compliance. Explanation: the captive manager plays a crucial role in overseeing the day-to-day operations of the captive insurance company, including ensuring compliance with regulatory requirements. They handle operational tasks like managing claims, working with actuaries, assisting with reporting, and ensuring that the captive adheres to both state and federal regulations. They do not typically set premiums or make all financial decisions. C. As these are usually handled by the board and actuaries. Claims management and loss reserving D are also part of their duties, but not the only functions they perform. Question 11. Which of the following is a common reason why a business might choose to form a captive insurance company? A. To reduce the amount of taxes owed to state and federal authorities. B. To increase its access to commercial insurance markets. C. To better manage its own risks and insurance costs. D. To avoid regulatory oversight in the insurance industry. Answer C. To better manage its own risks and insurance costs. Explanation: businesses often form captive insurance companies to gain more control over their risk management strategies and insurance costs. A captive allows a company to retain and manage more of its own risk rather than purchasing insurance from the commercial market. This can lead to more stable pricing and potential cost savings. While there may be tax benefits, avoiding regulatory oversight, D, and access to markets, B, the primary reason is generally risk management and cost control. Question 12. Which of the following is true regarding the capital requirements for a captive insurance company in Alaska? A. Capital requirements are determined on a case-by-case basis depending on the risk profile. B. Alaska does not have any minimum capital requirements for captives. C. The capital requirement for captives is set at a flat rate for all types of captives. D. The minimum capital requirement is solely based on the size of the parent company. Answer A. Capital requirements are determined on a case-by-case basis depending on the risk profile. Explanation: in Alaska, as in most states, capital requirements for captive insurance companies are determined on a case-by-case basis considering factors such as the company's risk profile, the types of insurance it plans to write, and its financial strength. This allows for flexibility in setting capital levels based on the individual needs of the captive. Alaska does not impose a uniform capital requirement for all captives as it assesses each case individually. Question 13. What is a key advantage of a group captive insurance arrangement? A. Low regulatory compliance costs for all participants. B. The ability to access larger reinsurance markets than a single parent captive. C. Greater flexibility in coverage options compared to traditional insurance. D. Low capital requirements for each participant compared to a single parent captive. Answer D. Lower capital requirements for each participant compared to a single parent captive. Explanation: in a group captive insurance arrangement, multiple companies come together to form a single captive. One of the key advantages of this structure is that the capital requirements are shared among the participants, which significantly reduces the amount of capital each participant needs to contribute compared to a single parent captive. This can make it more affordable for smaller businesses to form or join a captive. The other options, such as lower regulatory costs, larger reinsurance access, B, and flexibility, C, are not typically more advantageous in group captives. Question 14. Which of the following is a primary regulatory responsibility of the Alaska Division of Insurance for captive insurance companies? A. Approving the pricing structure for each captive policy. B. Ensuring that the captive meets the state solvency and financial requirements. C. Auditing the captive's underwriting procedures on a monthly basis. D. Monitoring the investment portfolio of captives to ensure profitability. Answer: B. Ensuring that the captive meets the state solvency and financial requirements. Explanation: the primary role of the Alaska Division of Insurance in relation to captive insurance companies is to ensure that the captive meets the state solvency and financial requirements. This includes reviewing financial statements, ensuring sufficient reserves, and monitoring the captive's ability to meet its liabilities. The division does not typically approve individual policy prices or audit underwriting practices on a monthly basis. C. While they may monitor investments, the main focus is on solvency. D. Question 15. What is the tax benefit often associated with using a captive insurance company for self-insurance? A. Premiums paid to a captive insurance company are deductible as a business expense. B. Captive insurance companies are exempt from all federal and state taxes. C. A captive can write off 100% of its claims payouts as a tax deduction. D. Captive insurance companies are not required to file tax returns. Answer: A. Premiums paid to a captive insurance company are deductible as a business expense. Explanation: one of the primary tax benefits of using a captive insurance company is that the premiums paid by the parent company to the captive are generally deductible as a business expense, similar to premiums paid to a traditional insurer. This can provide significant tax savings. However, captive insurance companies are still subject to tax laws and must file tax returns, and they cannot write off 100% of claims payouts. C. Nor are they exempt from taxes. B. Question 16. What is the purpose of a loss portfolio transfer (LPT) in the context of captive insurance? A. To transfer claims reserves from a captive to a third-party reinsurer. B. To increase the capital available for new business by selling off old claims. C. To restructure the captive's investment portfolio for higher returns. D. To reduce the administrative burden of managing insurance claims internally. Answer: A. To transfer claims reserves from a captive to a third-party reinsurer. Explanation: a loss portfolio transfer (LPT) is a type of reinsurance transaction where a captive insurance company transfers its existing claims reserves to a third-party reinsurer. This helps the captive by providing liquidity and offloading the financial responsibility for past claims, allowing the captive to focus on future risks and operations. The LPT does not involve increasing capital. B. Restructuring investment portfolios. C. Or reducing administrative burden. D. Question 17. Which of the following is a key consideration when structuring a captive insurance company for a multinational corporation? A. The captive must be incorporated in the country with the highest tax rate to maximize benefits. B. The captive must comply with international insurance regulations and local tax laws. C. The captive should limit its coverage to only the domestic risks of the parent company. D. The captive is exempt from local regulations as long as it is incorporated offshore. Answer: B. The captive must comply with international insurance regulations and local tax laws. Explanation: for multinational corporations, structuring a captive insurance company requires careful consideration of both international regulations and local tax laws. The captive must comply with regulatory requirements in all jurisdictions in which it operates. This can include adhering to insurance regulations in the domicile country as well as understanding tax obligations in each country. The other options are incorrect because the captive must be structured to comply with various laws and cannot be exempt from regulations. D. Question 18. Which of the following best describes the role of the board of directors of a captive insurance company? A. The board is responsible for managing the day-to-day operations of the captive. B. The board oversees the strategic direction, risk management, and financial health of the captive. C. The board approves all claims for the captive's policyholders. D. The board handles the pricing and underwriting of policies within the captive. Correct answer: B. The board oversees the strategic direction, risk management, and financial health of the captive. Explanation: the board of directors of a captive insurance company typically has a strategic role focusing on overseeing the overall direction, risk management policies, and financial health of the captive. They are not involved in day-to-day operations or in handling claims directly as C. They may provide oversight on pricing and underwriting, but are not directly responsible for these activities. D. Which are typically managed by the captive manager or other professionals. Question 19. Which of the following is a risk commonly associated with captive insurance companies? A. Limited ability to diversify risks across different industries. B. Higher operating costs due to the need for extensive regulatory filings. C. Inability to access commercial reinsurance markets. D. Increased exposure to financial volatility in the broader insurance market. Answer: B. Higher operating costs due to the need for extensive regulatory filings. Explanation: One risk associated with captive insurance companies is the higher operating costs due to the extensive regulatory filings and compliance requirements they must adhere to. Captives must meet the regulatory standards of their domiciles, which can lead to higher administrative costs. While limited diversification and access to reinsurance markets (C) can be concerns, they are not as common as the regulatory burden faced by captives. The exposure to broader market volatility (D) is also a concern, but less directly tied to captive formation. Question 20. In the context of captive insurance, which of the following is a key advantage of establishing a protected cell captive (PCC)? A. It allows for complete separation of assets and liabilities between different cells within the captive. B. It exempts the captive from regulatory oversight and reporting requirements. C. It provides unlimited coverage for any insured entity within the captive. D. It mandates a single management team for all cells to reduce operational costs. Answer: A. It allows for complete separation of assets and liabilities between different cells within the captive. Explanation: a protected cell captive (PCC) is structured to segregate assets and liabilities among individual cells within the captive. This separation ensures that each cell's assets are legally protected from the liabilities of other cells, providing significant risk management benefits for the insureds within each cell. This structure is advantageous for businesses with multiple entities or clients that require distinct risk pools. PCCS still operate under regulatory oversight and are subject to specific reporting requirements. Question 21. Which of the following is a primary benefit of forming a segregated cell captive of SEC? A. It allows multiple unrelated businesses to pool their insurance risks under a single captive. B. It enables a captive to separate and protect the assets of different policyholders by creating separate cells. C. It reduces the regulatory requirements for captives compared to traditional captives. D. It mandates a fixed rate of return on investments made by the captive. Answer: B. It enables a captive to separate and protect the assets of different policyholders by creating separate cells. Explanation: a segregated cell captive (SEC) allows a captive insurance company to create separate cells within the same legal entity, each with its own assets and liabilities. This structure enables businesses to segregate risks and financial obligations while benefiting from the efficiency of a shared infrastructure. This separation protects the assets of one cell from the liabilities of another. While SCCS provide advantages in terms of risk segregation, they do not reduce regulatory requirements (C) or guarantee fixed investment returns (D). Question 22. Which of the following is a common reason that a company may choose an offshore domicile for its captive insurance company? A. To avoid international regulatory standards. B. To access more favorable tax structures and regulatory environments. C. To reduce the premium costs of their policies by avoiding domestic market volatility. D. To increase the cost of compliance with local insurance laws. Answer: B. To access more favorable tax structures and regulatory environments. Explanation: many businesses choose offshore domiciles for their captive insurance companies because these jurisdictions often offer favorable tax structures and regulatory environments. These can include low capital requirements, tax incentives, and more flexible regulatory frameworks that may not be available in onshore markets. However, offshore domiciles are not chosen to avoid international regulatory standards (A) or to increase compliance costs (D). Question 23. What is the role of the captive manager (ICA captive insurance company)? A. To underwrite all of the captive's policies and set the premiums. B. To serve as a representative for the captive in meetings with regulators and investors. C. To manage the day-to-day operations, including claims handling and accounting. D. To act as the sole investor in the captive's investment portfolio. Answer: C. To manage the day-to-day operations, including claims handling and accounting. Explanation: the captive manager is responsible for the day-to-day operations of the captive insurance company. This includes overseeing claims handling, accounting, regulatory compliance, financial reporting, and other operational functions. While they may assist with underwriting and regulatory communication, they do not typically set premiums or act as the sole investor. Question 24. In the context of a captive insurance company, what is meant by reinsurance? The practice of transferring a portion of the captive's risk to another insurer or captive. B. The process of self-insuring all of the captive's risks to save on premiums. C. The action of cancelling a captive's policies to reduce claims exposure. D. The transfer of claims handling duties to a third-party administrator. Answer: A. The practice of transferring a portion of the captive's risk to another insurer or captive. Explanation: Reinsurance involves transferring a portion of a captive's risk to another insurance company or captive. This allows the captive to share its risk exposure, manage its overall risk profile, and ensure that it has sufficient capacity to cover larger claims, while self-insuring. B. Or transferring claims handling duties. D. Are part of risk management strategies. Reinsurance specifically refers to sharing risk with another insurer. Question 25. What is a potential disadvantage of using a captive insurance company for risk management? A. A captive may have lower capital reserves compared to traditional insurance companies. B. Captives require significant upfront capital investment and ongoing maintenance costs. C. Captives are not able to provide insurance for workers' compensation or property risks. D. Captives do not offer the same tax advantages as traditional insurers. Answer: B. Captives require significant upfront capital investment and ongoing maintenance costs. Explanation: One of the main disadvantages of using a captive insurance company is the significant upfront capital investment required to form the captive, as well as the ongoing administrative and regulatory maintenance costs. These expenses can make captives less cost-effective for smaller businesses. While captives offer a variety of tax advantages, they are not without costs and complexities. Question 26. What is the primary difference between a single-parent captive and a group captive? A single-parent captive insures the risks of a single organization, while a group captive insures the risks of multiple unrelated organizations. B. The group captive is only available to multinational corporations, while a single-parent captive is available to small businesses. C. A single-parent captive does not require any regulatory approval, while a group captive does. D. A group captive typically insures only property risks, while a single-parent captive insures liability risks. Answer: A. A single-parent captive insures the risks of a single organization, while a group captive insures the risks of multiple unrelated organizations. Explanation: The single-parent captive insurance company is created by one organization to insure its own risks. In contrast, a group captive involves multiple unrelated organizations coming together to pool their risks. This allows smaller businesses to access the benefits of captive insurance without the financial burden of forming an individual captive. Group captives are not limited to multinational corporations. B. And both types require regulatory approval. C. And can insure a range of risks, not just property or liability. D. Question 27. Which of the following is true regarding the solvency of a captive insurance company? A. Solvency is determined solely by the amount of capital invested by the parent company. B. A captive must meet specific solvency requirements set by its domicile jurisdiction to ensure it can cover future claims. C. Captives are not required to maintain any minimum capital requirements for solvency purposes. D. Solvency is irrelevant for captives that write policies for only low-risk exposures. Answer: B. A captive must meet specific solvency requirements set by its domicile jurisdiction to ensure it can cover future claims. Explanation: To ensure financial stability, captive insurance companies must meet solvency requirements set by the regulatory authorities in their domicile jurisdictions. These requirements ensure that the captive can cover its future liabilities and obligations. While capital investment is a factor, solvency involves more than just the amount of initial investment, and it is crucial regardless of the types of risks the captive insures. D. Question 28. Which of the following types of insurance coverage is typically not offered by a captive insurance company? A. Workers' compensation. B. Cyber liability insurance. C. General liability insurance. D. Life insurance. Answer: D. Life insurance. Explanation: Captive insurance companies typically focus on providing coverage for risks such as general liability, workers' compensation, cyber liability, and other types of commercial insurance. Life insurance is generally not a common product offered by captives due to its distinct regulatory and capital requirements. Captives are more focused on property, casualty, and liability risks rather than life insurance. Question 29. In a captive insurance arrangement, what is the primary purpose of fronting? A. To allow the captive to reinsure its own risks with a commercial insurer. B. To enable the captive to issue policies through a licensed commercial insurer for regulatory compliance. C. To transfer the captive's liabilities directly to the insured without any intermediary. D. To ensure that the captive pays lower premiums on its reinsurance contracts. Answer: B. To enable the captive to issue policies through a licensed commercial insurer for regulatory compliance. Explanation: Fronting is a process where a captive insurance company partners with a licensed commercial insurer to issue policies. The commercial insurer issues the policies on behalf of the captive to meet regulatory requirements, especially in jurisdictions where captives cannot directly underwrite certain types of policies. The captive then typically assumes most or all of the risk through a reinsurance agreement. This arrangement helps captives operate in regulated markets where direct issuance may not be possible. Question 30. What is the primary function of stop-loss insurance, a captive insurance structure? A. To protect the captive against catastrophic losses that exceed a specified threshold. B. To guarantee a minimum return on the captive's investment portfolio. C. To provide coverage only for low-frequency, high-severity losses. D. To limit the number of claims the captive can process in a given year. Answer: A. To protect the captive against catastrophic losses that exceed a specified threshold. Explanation: Stop-loss insurance, often used by captive insurance companies, protects against catastrophic losses by setting a maximum limit on the amount of risk the captive must bear. If claims exceed this threshold, the stop-loss insurer covers the excess amount. This helps captives manage financial stability by capping their exposure to large, unexpected losses while allowing them to retain more predictable, manageable risks.